The least squares moving average, or LSMA, is an advanced statistical technique used in time series analysis and financial markets. LSMA combines traditional moving averages with the least squares regression method to better model underlying trends in data. To understand LSMA, let's visualize a price series with natural market fluctuations. A simple moving average gives equal weight to all data points in the calculation period, resulting in a line that follows the data but with some lag. The least squares moving average fits a regression line to the data points within the specified period, resulting in a smoother representation that better identifies the underlying trend. Unlike simple moving averages that treat all data points equally, LSMA uses regression to fit a line that minimizes the sum of squared distances from data points. This method significantly reduces lag, allowing for more timely identification of trend changes. The result is a smoother representation that better captures the true trend while minimizing the impact of market noise. LSMA has valuable applications across multiple domains. In time series analysis, it helps identify underlying patterns without the distortion of noise. In financial markets, traders use LSMA to identify trend direction and potential reversal points with greater accuracy than traditional moving averages. Its ability to reduce noise while preserving the essential trend information makes it particularly valuable for analyzing volatile datasets. In summary, the least squares moving average offers a regression-based approach that provides superior trend identification compared to traditional moving averages. The mathematical foundation of the least squares moving average is based on linear regression. In this equation, m represents the slope or rate of change, while b is the y-intercept or starting value. To visualize regression, let's consider price data over time. Here, we have a series of price data points that show some variability over time. The least squares method finds a line that minimizes the sum of squared differences between the data points and the line. These squared differences represent the errors between our actual data points and the values predicted by our regression line. The regression line is calculated by minimizing this sum of squared differences. Mathematically, we find values of m and b that minimize this formula. The least squares moving average applies this regression technique to a moving window of data points. Imagine we have price data over a longer period of time. Here we have price data points over 15 periods. Let's say we choose a 5-period window for our analysis. For each window, we calculate a regression line using the least squares method. The LSMA value is the endpoint of this regression line, representing the fitted value for the most recent period. As time progresses, our window shifts forward, covering periods 6 through 10. For each window, we calculate a regression line using the least squares method. The LSMA value is the endpoint of this regression line, representing the fitted value for the most recent period. As time progresses, our window shifts forward, covering periods 11 through 15. For each window, we calculate a regression line using the least squares method. The LSMA value is the endpoint of this regression line, representing the fitted value for the most recent period. By connecting these LSMA values, we create the least squares moving average line. Let's summarize the mathematical foundation of the least squares moving average. The LSMA uses linear regression on a moving window of data. For each window, it calculates a line that minimizes the sum of squared differences. The LSMA value is the endpoint of this regression line, representing the fitted value for the most recent period. By applying this mathematical approach to price data, the least squares moving average provides a smoother, more responsive indicator for technical analysis. Let's compare the least squares moving average with traditional moving averages, examining their key differences. The simple moving average gives equal weight to all prices in the calculation period. The exponential moving average assigns more weight to recent prices, with weights decreasing exponentially for older data. The least squares moving average uses linear regression to find the best fit line through prices, minimizing the sum of squared errors. Let's visualize these differences on a price chart. We'll start with the raw price data. The simple moving average responds slowly to trend changes because it gives equal weight to all prices in the calculation period. The exponential moving average responds faster than the SMA, but still shows significant lag at turning points in the market. The least squares moving average responds more quickly to trend changes and produces a smoother line with significantly less lag. At trend reversal points, we can clearly see how LSMA identifies changes more quickly than traditional moving averages. The least squares moving average offers several advantages over traditional moving averages. It responds faster to trend changes, shows less lag at turning points, produces a smoother line with less noise, and is better at identifying true market trends. These differences stem from how each moving average weights price data. SMA gives equal weight to all prices. EMA assigns exponentially decreasing weights. LSMA effectively gives increasing weight to more recent data through the regression calculation. Let's calculate the least squares moving average using a simple example with 5 data points. First, we need our price data and corresponding time periods. For this example, we'll use 5 prices: 10.5, 11.2, 10.8, 11.5, and 12.1. Let's plot these points on a chart where the x-axis represents time periods and the y-axis represents prices. To calculate LSMA, we need to find the linear regression line. This requires calculating x squared and x times y for each data point. Let's calculate the sum of each column. These sums will be used in our linear regression formula. Now, we can calculate the slope of our regression line using this formula. The slope tells us the direction and steepness of our trend. Let's substitute our values and calculate the slope. Next, we calculate the y-intercept using this formula. Let's substitute our values and calculate the y-intercept. Finally, to calculate the LSMA value, we substitute the latest x value into our line equation y equals mx plus b. Let's calculate the LSMA value for our latest period, which is time period 5. Let's visualize our linear regression line and highlight our calculated LSMA value of LSMA rounded at period 5. This is the complete process for calculating a least squares moving average. The LSMA value represents the ending point of our linear regression line. Now we'll explore how the least squares moving average is applied in technical analysis for financial markets. One of the most common applications is using price crosses of the LSMA line to identify potential trend changes. When price moves from below the LSMA line to above it, this often signals a bullish trend change and can be used as a buy signal. Conversely, when price crosses below the LSMA line, this may indicate a bearish trend change, suggesting a potential sell signal. These crossover signals help traders determine optimal entry and exit points for their positions. Another valuable application of LSMA is analyzing its slope direction to gauge trend strength. An upward sloping LSMA indicates a bullish trend strength, while a downward sloping LSMA suggests bearish momentum. Traders often use the slope direction to confirm the strength of the current trend before making trading decisions. LSMA is frequently combined with other indicators such as simple moving averages to generate more reliable trading signals. When LSMA crosses above a shorter-term simple moving average, it can signal a strong buy opportunity. Similarly, when LSMA crosses below the SMA, it can indicate a sell signal. These moving average crossovers are considered more reliable than price crossovers alone, as they filter out some market noise. One of the key advantages of LSMA is its ability to reduce whipsaws during sideways markets. In sideways markets, price often fluctuates without a clear direction, causing traditional indicators to generate numerous false signals. LSMA's mathematical foundation helps it better filter out random price noise, reducing the number of false signals compared to simple moving averages. By focusing on the underlying trend rather than short-term fluctuations, LSMA provides clearer entry and exit signals, particularly valuable in choppy market conditions. The least squares moving average is particularly effective at identifying market trends. In an uptrend, both the price action and the LSMA line are rising. This signals a strong bullish market. The slope of the LSMA line is positive during an uptrend, indicating bullish momentum. The steeper the slope, the stronger the trend. Conversely, in a downtrend, both the price and the LSMA line are falling. This indicates bearish market conditions. During a downtrend, the LSMA line has a negative slope, indicating bearish momentum. A steeper negative slope indicates a stronger downtrend. In a sideways or ranging market, the LSMA line flattens, indicating a lack of strong directional bias. When the market lacks direction, the LSMA line has minimal slope. This indicates equilibrium between buyers and sellers and often signals that traders should be cautious or avoid directional trades. Traders can use the LSMA slope to make informed trading decisions. When the slope is positive, look for buying opportunities. When the slope is negative, consider selling or shorting. When the slope is flat, it's often best to wait for clearer directional bias. A key advantage of LSMA is its ability to identify potential trend reversals early. Pay close attention to changes in the LSMA slope, as these often precede significant price moves. Notice how the LSMA slope begins to flatten and then change direction before the full price reversal becomes obvious. This early signal helps traders stay on the right side of the market. To summarize, the LSMA is a powerful tool for trend identification. Its slope provides valuable information about trend direction and strength, while changes in slope can signal potential reversals. By aligning trades with the LSMA slope direction, traders can significantly improve their market timing and increase their probability of success. Combining the least squares moving average with other technical indicators creates a more robust analysis framework. This approach confirms trends, reduces false signals, improves timing, and helps create a comprehensive trading system. LSMA works exceptionally well when combined with momentum indicators like RSI or MACD. When the LSMA shows an uptrend and RSI moves above 50, this provides a stronger confirmation of bullish momentum. This point shows a buy signal where LSMA turns upward and RSI confirms the momentum. Traders look for alignment between the trend shown by LSMA and the momentum confirmed by RSI. LSMA can also be combined with volatility indicators like Bollinger Bands to identify potential breakouts. Bollinger Bands show market volatility and potential price targets. When LSMA crosses above or below the bands, it can signal the beginning of a strong trend. Here, the LSMA crosses above the upper Bollinger Band, suggesting a strong bullish breakout. This combination helps traders identify strong breakout signals while filtering out false moves. A comprehensive trading system combines LSMA with multiple indicators for better decision-making. The LSMA serves as the foundation for trend analysis, while other indicators provide complementary insights. This integrated approach reduces false signals, provides clearer entry and exit points, and adapts to different market conditions. Let's examine a practical trading example that combines LSMA with RSI and Bollinger Bands. The price action shows several potential opportunities, but using multiple indicators helps identify the most reliable signals. First, we add the LSMA to identify the underlying trend direction. Next, we add Bollinger Bands to show market volatility and potential breakout points. Finally, we check the RSI value to confirm momentum is aligned with our trend analysis. This point shows an ideal entry signal where LSMA turns upward, price is near the lower Bollinger Band, and RSI confirms positive momentum. Later, we see an exit signal as the LSMA begins to flatten, price touches the upper Bollinger Band, and RSI shows potential overbought conditions. By combining LSMA with complementary indicators, traders can build a more robust system that provides clearer signals and reduces false alarms. Understanding the limitations of the least squares moving average is crucial for effective application. Like all moving averages, LSMA is a lagging indicator. It follows price action rather than predicting it. This lag becomes particularly evident during trend reversals, where the LSMA continues in the original direction before catching up to the new trend. The performance of LSMA varies significantly based on market conditions. In trending markets, LSMA performs well by smoothing price action while maintaining the overall direction. However, in choppy or ranging markets, LSMA can generate numerous false signals as it struggles to identify a clear direction. Higher market volatility further decreases reliability, making LSMA potentially misleading in certain market environments. Extreme price movements can significantly distort the LSMA regression line. Under normal price action, LSMA provides a smooth representation of the trend. However, when extreme price movements occur, such as gaps or news-driven spikes, they can skew the regression calculation. These outliers can cause the LSMA to misrepresent the actual trend, and it may take considerable time for the indicator to normalize after such events. Given these limitations, LSMA should never be used as the sole decision-making tool. Instead, integrate LSMA within a broader analytical framework that includes multiple technical indicators, fundamental analysis, and proper risk management. Confirming LSMA signals with other indicators can help filter out false signals. Fundamental factors provide context for technical signals, while risk management protects against adverse market movements. By understanding these limitations and implementing LSMA as part of a comprehensive trading approach, you can maximize its benefits while mitigating its inherent weaknesses. Now we'll examine how to implement the least squares moving average in real-world trading environments. There are three main implementation approaches: using built-in tools in trading platforms, writing custom code, or using API integration for algorithmic trading. Let's look at how LSMA can be implemented across popular trading platforms. TradingView offers one of the most straightforward implementations using PineScript. Here's an example code that calculates and plots LSMA. For traders who prefer programming their own indicators, both Python and R offer excellent libraries for implementing LSMA. Here's a Python implementation using NumPy and Pandas. This function calculates the least squares moving average by applying linear regression to each moving window of price data. The basic algorithm for calculating LSMA follows these steps. Before implementing LSMA in live trading, it's crucial to backtest your strategies. Several tools are available for backtesting, ranging from Python and R libraries to built-in platform features. Here are some best practices when backtesting LSMA-based strategies. Whether you implement LSMA in a trading platform or through custom code, the core calculation remains the same. Here's a visualization of LSMA applied to price data. Notice how the LSMA line smooths out price fluctuations while following the trend. To successfully implement LSMA in your trading strategy, keep these key points in mind.